Hi everyone, welcome to the ETF Elite portion of the Investment Committee for April 2025. Well, it's been certainly an eventful month. Obviously,
Yes.
with the update today, this morning, with Trump pulling back most of the tariffs, it's caused a massive move.
Pause the tariffs.
Pause the tariffs.
Yeah.
Okay, yes, waiting for negotiations. What do you reckon?
So I was on AusBiz today, and I think the best soundbite that I get is that it's a trader's market at the moment. So what's happened is the market was already pulling back on fear of the tariffs, and then last week when he actually hit it on Liberation Day, that's when the market had a full reaction to it. Now that he's paused it and we've had a bounce, I think, I don't think it's back to normal. Like we're definitely not going business as usual, but I do think we formed a bit of a low with the way that the market panic sold into Monday Asia. We've had the strongest bounce in I think 5 years.
Nasdaq was up 12% overnight, right?
I've never seen the Nasdaq up 12%. That's huge. So I wasn't there for the tech bubble. So 12% sounds amazing to me. So I do think that the highs that were made, I believe in February, and then the low made on Monday, I think that's the trading range that we have to play with for a little while going forward. And I think it's all about obviously tariffs. So what we've seen is that that whole first pullback was just basically Trump announcing something, and then here again Trump announces something. But I think underneath it all, fundamentally, I think the economy is still doing okay. There's still positive job growth in a lot of the Western economies. So it's not like the GFC or COVID, where we had pretty much either a credit crisis or an external event that shocked the market. I think overall, what it was is just uncertainty over Trump's policies and the markets.
Well, it's a bit artificial, right?
Yeah.
But I do think if the tariffs stick around, I do think it does have implications for the real economy.
Absolutely.
And this is what we're seeing in the bond markets, right? Because there's a discrepancy here. Even yesterday, when the market was selling off, the bond yields were actually going up.
Yep.
So the bonds were selling off as well. There could be a couple of factors. Obviously, there's rumors basically saying, maybe there's a big player who's selling the bonds, the long-term treasury bonds, or it could be China. Who knows? They're all speculation, right? But it is very notable that the yields have, given us a bit of a, the bond market is generally us a bit smarter in terms of the money there is mostly institutional. So I think that the bond market's got it right. It's an inflationary situation. I don't think the Fed's going to move. But I think the big question mark that we have now is, obviously Trump's rolled back most of the tariffs, right? Paused it. Could get better with some of the countries, who knows, right? But I think the big hanging thing is China. So that whole tariff is still there. And I think, I think them increasing it is really not going to do much more to the market confidence, because they are basically at extreme levels where it's effectively an embargo, right? So even if Trump was to raise another 100%, what's the difference? Because the suppliers cannot, even with a 100% increase in tariffs, it basically, you can't do trade for China. You can't do trade with the US. Likewise with the US going back into China as well. The massive tariffs placed on there, it's impossible. Right?
Yeah, exactly.
So, but I think that's the room where he could throw out another wild card where he goes, you know what, we've actually negotiated a deal with China, or something changes on that front. That's really the unknown threat at the moment.
Yeah.
So.
Yeah. So basically, we've got the two superpowers. So you've got China and the USA. It's pick a side at this stage. So it's interesting times at the moment. And I just want to note that the first part of this investment committee was done on the Monday.
Yes.
And we're doing this on the Thursday, which is after the pause as well. So that's what
a lot's changed.
Exactly, a lot's changed in that short time frame as well.
Yeah. So let's have a look at the performance of the ETF portfolio. Let me just get the slides done properly. Okay. So we'll have a look at first the historical S&P correction. This was before obviously the rebound today, right? You can see that it's the move is spectacular.
So where did it get down to? Was it 48? I think the low was?
Yes, I think. Oh, yeah, I think it spiked down there on Monday.
Yeah.
Right. Oh, sorry. One sec. I'll go on the wrong way. So, let's go back to the ETF Elite portfolio. We've actually done really well over this, right? So we basically have kept up with the index and done a little bit better. So some areas we have done worse, where with BHYB, because we're seeing all the bond yields increase, BHYB has actually sold off a little bit. It went from $9.90 to about 60 something. So it's not a huge move, but still for a bond product, it's a fairly significant move.
Yeah, that's so what was that? That's about a 3% move, isn't it? Yeah. So which is massive for
decent,
yeah. So we want something that's usually it moves in bips,
Yes.
not 30 bips, but we're usually looking for something that moves 1 bip at a time.
Yeah. So it's fairly significant, right? Where
we've also got 20% allocated to it, so that's why that's why the swing.
Yeah, that's right. So it's fairly chunky. We did well with gear. So basically, with gear, we held off cash. We averaged in at the first clip at I think it was like 50. Oh, we'll have a look at the chart when we come to it. But I think it was like at 7,800, somewhere around there. And then we add another clip at a bit low at about 7,200.
7,200, yeah.
So there's those averages really do help. So yeah, they've done great. But obviously, some of the active portions we've cut because we just wanted to take more risk off the table, right? So for GPEG, we want to take that off. Private equity, I don't think in this environment it's the right thing to be in. Wire as well, because with all the China-related stuff, it's risk off. The commodities, obviously the precious metals have done. Silver got hit last week, but it has recovered.
And also wire was disappointing. So the thing with wire was that copper went to record highs, and wire disappointed. So wire is the copper miners, one is the actual spot price, and there was a big discrepancy. So time to cut. And I guess the great, the market's always trying to teach you lessons. And we came into ETF Elite just looking for something that beats the benchmark all the time. And one thing we did learn is that there's a lot of in the previous how we back tested and looked at past performance of certain ETFs, we kind of just looked at that versus the XJO, and then what this pullback has shown is that the overvalued Nasdaq dropped a lot more than the XJO as well. So just highlighted the things that we need to, the risks that we didn't know about. Look, now obviously, I wouldn't say didn't know about it, but we didn't expect that to be such a big move. But so,
and I think also, well, before the Thursday last week, I think we were ahead of the index by 2 point something, so around the 2% mark, which was very good for a quarter of performance, basically, right?
Yeah.
I think it's doing what it's supposed to do. We're still about 1% and a bit ahead of the market. I think we positioned incredibly well. If we put too much into gear earlier on, I think we would have got more hurt in this move.
Yep.
But we positioned well, and I think we are still positioned. This today gave us a really good opportunity to get out of grep, and we averaged in lower long in gear. So this puts us in a really good position, comfortable position, and we're actually into more cash, right? So we'll go to our current holdings now. So we're at about 13% holding of cash, right? And I think it's a good level because it's had a massive rebound. We got out today with grep, so that's the majority of
GPEQ.
GPEQ, right? So we're at a decent cash level again after taking off GPEQ. I think we're at a very comfortable level of gear and BHYB, and the rest we're pretty comfortable with. I mean, A yields, it's interesting, right? Because in these down moves, it doesn't actually hold up as well as I thought it would. But it still has enough in the long run. It still has enough coupons to kind of cover for that, right? So I think it's not a short-term play, but a lot more longer-term play where you're relying on the coupons to pay off. But in these market sell-offs, it does get mispriced as well, so they will sell off as well. I think
that kind of just shows you the kind of market we're in. It's not. It's these things have a fundamental nature to them.
Yeah.
But if someone needs to liquidate, exactly. That's where you get distortions, and that's where you also get opportunities.
Exactly. I think Defend we've picked incredibly well. Defend is one that I'm most confident in. I just think, if you look at it fundamentally, all this trade war stuff, all this, it influences geopolitics. It's shifting geopolitics massively, and it's not for the better, right? And like I was listening to Ray Dalio's, basically the cycle, the big cycle, right? You have a declining empire with a rising empire. There's basically, I think it was like 9 out of 11 occurrences that it's occurred in recent history. It's always led to a conflict. Right? So I think in the last couple of years, we're really seeing that play out where, it's really, we saw it from a long way away where you go, okay, well, China is the upcomer and the US is obviously the dominant power in the world, right? But it's really coming to a head. And the latest news is kind of just an expression of where we're at close point where there's going to be direct confrontation. Maybe not militarily, but it's already direct, very direct, right? So they're not tiptoeing around it anymore.
Oh no! So if you, so a lot of the podcasts I've listened to, they're calling it, and actually, it's not a kinetic war. So you don't actually see it but there's a lot of, they said, hot wars in cold places. So places like, say, in the North Pole, there's already been, undersea cables cut and things like that. So, but this is away from public eyes. But yeah, there's definitely a lot more going on than we see out there.
So I think this is a really good hedge for the geopolitical tensions and troubles that come in the next couple of years, right? So I think the defense stocks will always be a good pick. We've got to time it right, but I think it's the theme to be medium theme to be on. Healthcare in this downturn, it's held up spectacularly in the US, and as it should. Like we back tested this over 20 years. These counter-cyclical stocks, staples, healthcare, not so much utilities. Utilities is a mixed bag. But generally, healthcare and staples are always the one that people rotate to in these risk-off markets.
Yeah, as Mark was saying, it's all about needs, not wants.
Correct. So yeah, that's done very well. Happy holding on to that position. Qual is the one that we were talking about. I'm still, to be honest, I'm not really worried about this because I think even though it's fallen, as we saw today, the bounce is also as aggressive out of that.
So what you got to remember is that Qual actually has a lot of the Mag 7 in it because they're the biggest and the best, and that's why it's had a decent fall there.
Yes.
So I guess I'm like you. I'm happy with the current mix that we do have.
Yeah.
It's just a matter of probably the only one I don't think that we should have is some precious metals exposure. I mean, like I'm the self-confessed Osby's gold bug. But if you look at all the charts through all the commodities, all the stocks, gold is the only one that held up through all of this.
Absolutely.
So gold, I think it got down to maybe just under 3,000 at one stage, and it's back at 3,100 now.
It's a Sora value, right?
Yeah.
It's not an industrial metal.
No.
Silver, there is a portion of. Well, I mean, the predominant use of silver is still a industrial metal, right? And this is why it got hit along with copper as well. And if you're under pressure of margin calls, so basically, like a lot of these things are traded in futures or with margins or whatever. When accounts get liquidated, your riskier positions go, right? And so silver, a lot of this would have been pressure from liquidation calls. They have to get rid of the risky assets. Gold obviously has been much more stable. And even in the bounce back, we've seen it keep up pace. I agree. I think that theme continues.
Yeah.
I think it's just, for me, it's more about timing. When do we get in?
For me, it's just it didn't fall then. I think it'll just bust through the highs. So that's my vote, but we shall see.
Yeah. So, well, let's take a look at the charts, right? So, gear, I had gear on there because it's just the most direct. We might as well look at that as opposed to the ASX 200. Well, you see, here, this was just wow.
Yeah.
Like, what an opportunity. Well, because we bought around here. Well, it was like 23.50, I think it was.
Yeah.
So beautiful average. I mean, where was it? I think we averaged in here and then here. So our mid price for the 5% will probably be somewhere here. So, I mean, I think we did all the right things.
Yeah.
I don't think I would have done anything else different. Maybe a little bit more at the bottom. I don't know, but it was very difficult to tell at that time, right? It's always easy on hindsight.
As you said, like it's easy to say now. Oh, I should have bought more.
Yeah.
And that's I guess that's one of the things about charting and just trading in general is that it's very easy to look back and go, oh yeah, you just buy then when this line crosses that line, easy. Yeah. But the thing is, we're humans, we're running through emotions, so the emotions that you go through when it's looking like that versus afterwards when there's no pressure, there's a big difference there.
And it's a broken market, right? In these and like. We've been trading for numerous years, so like, and what you understand as a trader once you've seen these events, enough is when it breaks, and it doesn't really matter about value. It really doesn't. There is no liquidity. This could have gone down to 18, and the market would have stayed there.
Yeah,
right. The value doesn't correct until liquidity comes back, and the catalyst goes away, right? So it's very easy to say and look, okay, oh, we should have added another 5% on there. It could have gone down. If it went down to 18, the market wouldn't have batted an eye.
Yeah.
Right? But we would have been in a worse position. So it's kind of like hedging your bets and doing the right sizing for the right time.
Well, that's the thing. We knew we had to, as we said, protect our lead. They said, let's at least do the minimum and then we'll go from there. I mean, like in hindsight, always easy to say we should have backed up the truck.
Yeah.
But, just having that, do some sort of action at that stage. Yeah,
correct. We made the right trade.
Yeah.
Okay, so BHYB, that was the move that we were talking about. Fell from low 90s to the 70s, below 70s.
Yeah. So if you just want to say, so that's your normal trading range. That's probably about 10 bips, and it's moved 30 bips in that one go.
Very significant. And, that reflects what's been happening in the global bond markets, right? So this is the bit of an anomaly because even yesterday before the Trump rescinding the tariffs, we saw, basically the bond market's breaking down, right?
Yeah.
So the US Treasury is actually, the yield went up about 3%. So, sorry, not 3% in yield, but like 3% change. Mm-hmm. So a very, very big move. And typically, when you see a risk-off event, if the equity market's selling off, the bond is supposed to go
exactly.
The yield is supposed to go down.
Yeah.
Right? So this is the complete opposite, and there could be many factors that we talked about. Potentially as foreign interest.
Participating. So rumors were China were selling US Treasuries, but the thing is, the dollar index didn't support that. That theory.
Maybe not.
Yeah. And so that. I mean, that could have been the move that forced Trump to to do that as well. Like that's the other theory as well. But as Kai said, the main concern. I remember looking at that bar, and the markets were absolutely hit that day, and I just went, "Why are the bonds, bouncing 25 bips when the market's getting absolutely hosed?" So. And then, the continuation over the next couple of days, and then the reversal last night. So,
I think it highlights the fact it is inflationary. Mm-hmm. This is an inflationary tariff. Like, if it goes through, the bond markets will not. The Fed is not really willing to cut rates.
Yeah, and that's why the markets don't like stagflation.
No,
because there is nowhere to hide. You can't hide in the bonds because inflation is still running rampant, and you can't hide in stocks because the cost of funding is increasing, growth's going to stall down. Yeah. So that's why stagflation is the worst enemy for pretty much everyone in finance.
Yeah.
And it seems like the most likely event at the moment.
I think so. That's why we love gold, right? I think gold is a very good protection against. We just need to go and find timing.
Mm-hmm.
Defend, that's the stock up. That's the ETF up there. Pretty much at highs. So even through that whole move, you can see that it's held up exceptionally well. I think it just continues higher.
Yeah.
That's a good one. And then in terms of position changes, so obviously last month, we added to some gear, added to qual. Well, we added to gear, and qual. Whilst we sold off the Bitcoin positions. So we were at about 0.83 beta before the adjustments, right? So this was very conservative. But after coming into the lows, we actually discussed this, and we actually want to get our beta close to 1 now.
Yeah.
Because it's had the corrective move. Not saying that it won't go lower, but I think we should actually go and lock in basically our good work being conservative. And now we want to actually match the index.
Because the thing is, like, if we just have the beta 1, and then we've got a couple of the yielding plays within there, there's your natural advantage just there.
Exactly. So absolutely right. So that's why we added the 2.5% beta, the gear. So we took off GEPQ today, which is not the right environment for private equity. We also took off the Wire ETF a couple of days ago. But we are sitting. The only issue is that we're at we're at 0.97 beta, which I think is about right. But the challenging thing is we're at 13% cash, right? So I don't think this is a bad thing. It gives us space, and we're hedged off enough on the upside to ride out with the market, right? But it does leave us a lot of cash. So we could either put it into BHYB, but I don't know if that is the right decision because, I mean, you kind of get stuck in BHYB. There is still, as we saw today, there's bond yield risk. If basically we see treasuries go higher again and it pumps through some crucial levels, the BHYB will be under pressure as well.
Yeah, exactly.
Right? And we're not really getting the rewards for it because, if we're in there for a short time and we see a credit event, we actually need to be getting out of BHYB and rotating more into cash. So, yeah, I think I would like to be patient. If the market comes off again, which could be very likely within the next couple of weeks, I would love to buy more gear, lower, or qual. Gold as well. If I don't know if gold will have a pullback, it looks too strong. I want to buy the dip in gold. I don't want to buy the highs. I want to buy the dip, but I do want to get into gold. Any other suggestions?
Well, after pretty much all of the pretty much every asset got hit, it feels to me gold's still the as I say, the clean shirt of the gold standard. So it is the gold standard. So, and there's nothing that tells me that it's going to change anytime soon.
Yes.
The fact that even though Trump has paused, and the fact that he's maintained it with China, look, you can just see he wants either a deal done, or something to bring back manufacturing to USA. So, either the deal, whatever you want to call it, I don't see him trying to back down and claim a victory here. So I still think gold's play. And I just want to add that I think with the way silver came off and copper came off, let's just stick to gold itself.
Yes.
So not the NPM, which is what we had before with the precious metals. I think just stick with gold. I think gold miners is probably it makes sense fundamentally. But that's more of a trade rather than having a position in gold, store of value. We just hold that.
We try to play the medium or long game, right?
Yeah.
So, well, I guess what's the downside case for gold? Is there or is there any downside case for gold?
Okay, so I've had to think about this. So, if world peace, that's basically
fair enough. Yeah.
So it has to be some sort of like Middle East has to Israel and the Middle East has to become peaceful. China then have to, there's no more tariffs and suddenly globalization goes back. So basically the whole globalization trade has to resurface, and it's all about growth. If it's a growth scenario and it's all systems pumping, people will get out of gold because they don't want to have store value; they want growth.
Yes.
Yes. Whereas that's the bearish case for gold. But things have to change a lot.
Yes.
For it to think. So that's why I still think it's the even though it has had a very long and strong move. I mean, like I've been calling it since 2000. I still think it could have more to go, and it's just basically how things are playing out at this stage.
Okay. Well, let's try to buy the dip. What about tech stocks in general? Like, is there any opportunities in these tech stocks at the discount price?
I think we'd have to. So I still think AI is it's a revolutionary technology.
Yeah.
And I think it'll be like the internet stock bubble of the 2000s. There will be something that comes out of this that will be world changing. So we'd have to, but I think that's more company specific. So I don't know how we do that via ETFs. Maybe if there's an ETF that comes out.
Yeah. Or we need another major event, right? Like like not a deep sea moment, like an OpenAI moment.
Yeah.
Or like artificial general intelligence, or like some of these agentic AIs become so useful where it's like it's smarter than a real person. Like things like that. I think that could cause another break onto the upside for AI.
Yeah. So I still like the thematic, but it's just more about the valuations and the momentum and price action as well. If we do see, because we've had a great rise. We're starting to chop around now. We even had a breakdown on some of the stocks. If that were to resume, I'm happy to jump on. But at this stage,
I think valuations are fair now. I would say they're pretty fair.
Are they? Okay.
Yeah, I'll say the like Meta's pulled back probably like 40% from highs.
Really? Okay.
Nvidia's probably yesterday's low. Sorry, not after today. Not after today. But Nvidia even probably pulled back 40 close to 40%.
Well, I mean, so not a totally dismissed, but let's just keep an eye on things. But I think tech is a way to go forward as well.
Yeah. Okay. Well, I think we'll leave it there. I think to summarize it, we're in a good position.
Yeah, so we've had great start to ETF Elite.
Yes.
Call it skill, call it good luck, whatever it is. But basically, we've built up a nice lead, and we're doing as we want. We want to beat the index by small a certain amount each year, each quarter. And let's just keep looking for opportunities to maintain that lead and be smart about it.
We were outperforming target, and basically in this quarter we were up 2%. Now we're probably back closer to the 1% mark, or a little bit over 1%. But I think we're on target overall for the year, because the goal is basically 4 to 5% a year to beat, right? So I think keep just doing what we're doing. We're positioned well. We just got to find somewhere where it's low-ish risk for the extra cash that we have.
Yeah. Oh, it's all about risk-adjusted returns. We want to make returns, but we don't want to take a lot of risk.
No. All right. Thank you guys for joining us.